Hi, this is Adrian here. In this video, I'm going to share with you the differences between the term insurance and the life insurance, and I'm going to throw some other insurance policy types into the mix just to make this a little bit more complete and to allow you to have a better understanding of the policy types around, and you can make a better judgment of which one will suit you best at which circumstances. Let's dive right in. So to start, let's have an understanding of what is a term insurance. Now, term insurance, like what it is mentioned here, it covers for a specific terms. So it could be for 10 years, 5 years, 15 years, so on and so forth, up to 25 years or even more. Some policy cover up to 99 years old as well. Right. So then what are the coverage that comes with a term insurance? So a typical term insurance can cover for many things. As long as they do not have cash value, usually they will come under a term insurance. So for example, it could come in the form of a death coverage or coverage that covers for total permanent disability, terminal illness, critical illness, early stage critical illness, and in recent times, we have like multi-pay critical illness, and you could also add in like premium waiver into the mix as well. So what are some of the things that makes a term insurance so different from a life insurance? Number one thing is that there is zero cash value. There is absolutely no cash value at all, which means that you cover for a specific term. At the end of the term, if nothing happens to you, there's no money back. Right? But because of that, the premium is generally much lower than the rest. So this offers you a different kind of perspective into how you want to add this into the mix, which I will cover a little bit more later on. Now, before we go into life insurance, let's take a look at somewhere that is in the middle, which is what we call an endowment plan. So an endowment plan, in recent times, there is little coverage at all. Little or no coverage at all, because of the fact that most people who want to build their wealth accumulation using endowment plans, they do not want to have coverage. If they want to have coverage, then they will go for like a term insurance or life insurance, other form of mechanism. But if you're holding on to the older endowment plans, those that are of maybe like 15 years ago or even 20 years ago, then you might encounter this as well. So for an endowment plan, it also covers for a specific term. It can be like for 10 years, 5 years, 25 years, even 30 or 40 years. Rarely will they have 99 years. And the older plans do provide coverage for death, total permanent disability. In some cases, they can offer a critical illness coverage as well. So because of the fact that there is a high cash value here, it means that your premium will be higher as well. Next is we are going to look at a life insurance. So for life insurance, as what it says in the name here, is meant to cover for your lifetime. So it is not for a specific duration, it's for your lifetime. And some of the things that you can cover here is generally rather similar to a term insurance, whereby you can cover for death, TPD, TI, critical illness, early stage critical illness. As of this point of time, they do not have multi-pay critical illness as a form of a life insurance. So up to early stage critical illness, and of course, you can add in your premium waiver as well if you do not have a critical illness full coverage. So what are some of the commonalities about this plan is that you have a mixture of like average cash value and average premium. So for life insurance, it's somewhere in between an endowment and a term insurance. And in the past, life insurance, you have to pay for your lifetime to cover you for your lifetime. But in recent years, there has been an increase in the trend of paying for a limited duration. So it could be for 5 years, 10 years, all the way to 25 years. Some could even allow you to pay up to 30 years. So you pay for a limited period of time and it covers you for your lifetime. And due to customer trend, there is some differences between the older life insurance versus the newer ones. I'm sure you may have heard of this term called a multiplier. This is something that's very common in today's policy, whereby, so what happens that in the past, right, your older life insurance will slowly climb, the coverage will slowly climb as you age. So it begins from somewhere that is at a very low level, and then, like 20 years down the road, 30 years down the road, then you increase by maybe like double the initial sum assured because of the cash value that is in the plan itself. So with a multiplier, what's happening here is that basically it is increasing your coverage from the start. And at 70 years old, 70 or even 80 or 85 years old, your coverage will drop. So this is based on the assumption that at the point of time where you are still working, which is your golden years, you would want to have more coverage because you have more responsibility and you have a longer lifespan from that time onwards. And after retirement, it is based on the assumption also that you have already accumulated what you need for your retirement, and at that point of time, you will need lesser coverage or even no coverage at all. And so this is for life insurance. And last but not the least, we are going to look at investment-linked policy. I know that investment-linked has come under very bad reps in recent times, but I'm just going to put it into the mix because it benefits a certain group of people. Now, what is an investment-linked policy? Investment-linked policy, it has a mixture of some of the features here. So first of all, it is a coverage for your lifetime. And there's no limited pay here. So, but in recent times, there is what we call a minimum investment period, whereby you have to contribute a minimum of 10 years all the way until maybe 20 years or so. The type of coverage that you can get from an investment-linked plan is very similar to a term insurance. So I've seen different companies offering different types of coverage here, but in general, you can get something that's very similar to a term insurance. It covers for death, total permanent disability, TI, terminal illness, critical illness, early stage critical illness, multi-stage critical illness, and a premium waiver can add them in as well. So with ILP, you have a mixture of a premium. So the premium, it could be higher, it could be lower, but generally when the premium is higher, it means that more amount is being put into the investment. It may be good, it may be bad depending on your circumstances. And there is also a mixture of investment value. Bear in mind that for ILP, they are investing directly into funds. But what are some of the unique features of ILP that may suit certain group of people? Now, first of all, it allows you to go on premium holiday. This is the only one in the list here that allows you to go on premium holiday whereby you do not have to pay for the premium and you can continue to enjoy the coverage from this plan. So this suits people who do not know whether or not in the future they would be encountering any financial trouble, they want to play safe, they may not be able to commit, then having an ILP might save them in the times of need whereby they are not able to contribute the premium but they are still covered. Now, so why is this important? It's because what is worse than having no money or having little income is that you fall sick and it drives your savings down even further. So this is a very good feature for those that fit this category. Now, the other thing is that for certain policy, I would say that for generally most ILP plans, they allow you to do partial withdrawal from the plan itself. So what this means is that if you have been putting in conscientiously, maybe like for the past 7-8 years, and then suddenly you need to withdraw a certain amount of cash from this policy, you have the ability to do so. Of course, this depends on the different type of plans, and in recent times, there are investment-linked plans that offer you 100% investment from the start of the policy, but they withdraw the partial withdrawal facility, or they impose additional penalty on partial withdrawal. So there you have it. We have the full suite of common policy types that are available in the market right now. So then, when do you choose what type of policy, or how do you know if you are suitable for which type of policy? Now let's take a look at this. Term insurance. When do someone require a term insurance? Now usually it's for a temporary cover. Like for example, if suddenly you have a twins and then 2 years down the road you have another pair of twins, right? Suddenly the burden of your shoulders increases by twofolds. And you can't be like keep buying life insurance all the way, right? Unless you have the ability to do so. But usually I would recommend that you can beef it up with a term insurance just to cover for that specific period of time, like that 10 or 20 years of the time where the burden of your shoulders is the highest. It can be for temporary. Or if you are getting a house, you want to temporarily cover for the mortgage loan, then you can get a term insurance that covers for the specific period of time. This is for temporary cover. Or it could be for someone who is very disciplined. So why do I say discipline? Because for someone who is disciplined and you do your own investment, then you might want to go for a term because first of all, it is the cheapest and it frees up your cash that you can do your own investment. But I've seen many people who wanted to go for term and do the investment on their own, and after a few years, they didn't do any investment at all. So this may backfire in the long term because instead of investing, you are doing nothing with your money, or even worse, you are spending your money away. So that's not the purpose of having a term insurance. It's not to allow to free up your cash so that you can spend away all your money. That's not what it is. So if you're someone that's very disciplined and you know that, okay, you have a very structured plan on how you can build towards your retirement and to build up your retirement fund in the future to cater for your medical needs, then a term insurance will suit you very well. How about for life insurance? Life insurance is almost like the direct opposite. So it is not for a temporary cover, it is for a long-term cover. So for some people who wants to have a long-term cover and not to worry about having to set up additional backup fund during their retirement years, then having a life insurance will suit them very well. And some of them they may not have a discipline, or they are not even doing the investment on their own. Then they might want to go for a life insurance because at the end of the day, when there's a cash value when you retire in the future, that will serve as a backup fund for you. So it is always good that when you retire, you have different backup funds around. It could be in the form of life insurance, it could be in the form of investments, REITs, different kind of mechanisms that come into play. This will serve you well even when the market is very volatile or not volatile. You have all these different sources of backup funds in place. And next, now for IRP, I do not recommend that you go for a long term because the insurance charge will increase over the years, even though they have this concept called the sum at risk, which means your sum assured minus the investment value and the remaining amount will be subjected to the insurance charge. So for IRP, the insurance charge starts from a very low end and it increases as you age. So for these type of plans, first of all, it is for temporary cover. Unless at the point of retirement, you are not incurring any additional insurance charge at all or very little insurance charge, then this might be something that you might want to go for. It provides you with a temporary cover and does not do any investment. Or you could be someone who is a smoker who wants to have a temporary cover. Or you have a medical condition, because if you are a smoker or you have a medical condition, sometimes the premium will be higher. And if you were to apply through the traditional term or traditional life insurance, you're paying additional higher premium from the start. So when the additional premium that you have to pay start at the lower end from an IRP, over time your investment value will start to increase as well. So this is a very good way for people who are smoker or who have medical condition that is incurring additional premium to go for IRP instead. So for endowment wise is very straightforward because recently endowment plans do not cover for death, so it will be just for wealth accumulation. And there are many different types of wealth accumulation options out there. It could be like for lifetime income, or it could be for a specific period of time. So there you have it. I hope this session allows you to have a better understanding of the different types of insurance policy, be it a term insurance, a life insurance, ILP, endowment. You just need to know that different policy suit different people. So it will be best to know what suits you at this point of time, and there's no good or bad insurance policy. It's just whether or not it suits you. So I hope that with this, you have a better understanding of what are the different types of policy and what circumstances can you use them for. So this is Adrian, and I'll see you in the next video.